Good evening. I'm Mike Knetter, and welcome to the UW Now, where we bring you experts from the Badger community talking about timely and important topics. The narrative around the U.S. economy is changing in some contradictory ways right now. On the one hand, major banks and economic forecasters are offering a brighter outlook on the U.S. economy. The Fed is getting inflation under control, it seems, without crushing economic growth, raising hopes for that elusive phenomenon that we call the soft landing. Who deserves the credit? Speaking of credit, the US Treasury's long-term credit rating was downgraded from AAA to AA plus by Fitch Ratings. Given the strong relative performance of the US economy during and after the pandemic, what's driving this ratings downgrade? Does it reinforce the movement away from the dollar as the global reserve currency? And how will it impact the nation and households? Joining us to shed light on these important topics are Dana Peterson, Chief Economist at the Conference Board, and Menzie Chin, Professor of Economics at the La Follette School at UW-Madison. Dana, you are our most decorated speaker. I think you now own the record for most appearances on our show. So it's great to have you back. And Menzie, I think this is your first time on the show. I know we've asked you before, but you had conflicts. So thanks for making time for us this evening. Really appreciate it. Kicking things off tonight will be Dana Peterson, Chief Economist and Center Leader of Economy, Strategy, and Finance at the Conference Board, which is a 501c3 nonprofit business membership and research organization. She's a leading analyst on many global economic themes, including monetary and fiscal policy, trade policy, debt, taxation, ESG investing, demographics, and much more. Her analysis is regularly featured by U.S. and international print and broadcast news outlets. Previously, she worked at Citibank and the Federal Reserve Board in Washington, D.C., and she is a 2023 recipient of the Luminary Award from the Wisconsin Alumni Association. And I promise to send you some red shirts, Dana, so you can sport some Badger wear next time. But really, welcome back to the live stream, and thanks for starting us off this evening. You always bring a wealth of well-organized information that sets a great tone for our discussion and for our audience questions. So please, without further ado, Dana Peterson.
Thank you, Mike. It's always great being here. So the reason why the U.S. has faced a sovereign debt downgrade in terms of its rating is not because of recession or avoiding a recession. It's all about debt. It's about federal government debt. So why is this? Well, we've had repeated crises episodes. So even this year, we had the debt ceiling crisis that came down to the wire in terms of whether or not we were going to go over the cliff. And probably in October, we're looking at another government shutdown. So when you have these repeated crises and political discord, it creates a lot of uncertainty for our investors and certainly for the economy. People who are investing in the US and also consumers and businesses. And then, really, this downgrade is also about this kind of future crisis that's in the making right now. So, I'm going to talk about what is this future sovereign debt crisis for the US. Let's go to the next slide, please. So, the US is heading towards a fiscal crisis. Why? Revenues are not rising fast enough. Outlays, which is what the government is spending, is not growing is growing too rapidly, faster than the revenues that we're getting in. Revenues come from taxes. There's also a lot of debt. It's high and it's rising. When we think about fiscal space, um, the US government always has the ability to tax and spend, but it comes at a cost, and that cost is very high debt. And that's not good for the US economy. It's not good for consumers. It's not good for businesses. And certainly, if we are going to reduce the debt, it's going to take decades. It's not the case that we can get it all done in 10 years, because that would really drive the US economy right into a pretty serious recession. So we need to make really tough choices, but there are smart policies that can get us there. So if you don't listen to anything else I say, this is why there's a sovereign debt crisis, but there's also solutions. Next slide. So let's take a look at some pictures. So we have US federal debt as a share of GDP. Some people like to look at it Some people don't like to look at this measure, but it's a pretty common measure. The CBO looks at it, lots of people like it. And you can see from 2010 that blue shaded area has almost gone vertical. And where you see the thin white line, that's where we are right now in 2023. And it's just going to get worse. Debt's going to rise to almost 200% of GDP by the time we get to 2053. So we are headed for a ton of debt. Okay, let's talk about why. Next slide. Well, first, why has debt swelled? Well, we've had multiple crises. We had the great financial crisis, we had the pandemic, and that prompted a fiscal response, meaning the federal government spent money to help support the economy, consumers, and businesses. You also had the Tax Cuts and Jobs Act, which cut taxes, but we didn't get the other piece, which was cutting spending to complement the tax cuts. We also have an aging population. The entire baby boomer generation is getting older and they are leaving the workforce. So that means you have fewer people to pay taxes. Meanwhile, you have more people that the government has to spend on in terms of healthcare and care for the and really lifestyles for the aging. And then there's really a lack of political will and public support for austerity. So politicians don't really want to get into this because they're on a 2-year election cycle. And it's not fun to say, well, we're going to stop spending. And certainly the public is not really in the mood for stopping spending either. And when we have tried to stop spending, so for example, back in 2011, when S&P cut the US's rating down to where they have it, I think it a double A plus from triple A. Um, the response was sequestration, which means across the board spending cuts for the next 10 years. But that didn't happen. Every few years, Congress would come and repeal it. And then we have some spending cuts that were made a part of the debt ceiling deal. Are those cuts going to hold, or are those going to be repealed away? So that's why we've gotten to where we are in terms of why debt has swelled. Let's go to the next chart. So why is it going to continue to expand and get close to 200% within the next 30 odd years or so? Well, like I said, you don't have enough revenues coming in. There's going to be a lot more spending on mandatory items such as Social Security, Medicare, and Medicaid. There's going to be exploding debt service. That's basically the interest on the debt, and that's going to continue to rise. And then I mentioned already the aging population and lack of political will. So all the things that got us here are going to continue and and into the future unless we do something about it. So let's I think we have some more pictures if we go to the next slide. Okay, so here's some pictures. So point blank, spending or outlays are going to far outpace revenues. And you can see that revenues have been falling since for some time, and that's because of the Tax Cuts and Jobs Act. It picks up a little bit when that act expires. That's if all the provisions that cut taxes are not perpetuated into the future. But even still, even with that little bit of a bump, you have more outlays and revenues. Next slide. And interest on the public debt is going to continue to rise. Even over the last year, it's pretty much gone vertical. Why? Because of the next slide. Because the Fed has been raising interest rates. The Fed has raised interest rates by 525 basis points so far. That should say the July FOMC meeting. But that's my fault. But they may raise interest rates one or two more times, and then certainly there may be cuts next year, but certainly not back down to the zero lower bound. So debt service is going to stay very elevated because it's unlikely the Fed, unless we have some other crisis or recession, that the Fed's going to cut rates back down to zero. Next slide. And so the CBO is estimating that debt service or net interest, is going to outpace growth in the primary deficit. So the primary deficit is basically revenues minus outlays, excluding interest. And so you can see that the navy blue bars, that's interest, that's going to be growing very rapidly. Meanwhile, outlays and revenues, the net of that is going to be not as big as a share of GDP. So this is not good. Next slide. And then when we think about mandatory outlays, so the blue bars are all different types of revenues, excuse me, all different types of revenues, but you can see things like the yellow bars and the orange bars. Um, that's Medicare, Medicaid, and Social Security, and those are just going to keep growing and becoming larger as a share of the budget every year and of debt, and certainly as a share of GDP. Next slide, please. And as I mentioned, we're going to have fewer and fewer working people to support all of the mandatory spending, which we call entitlements. So you can look at it two different ways. This chart says that way back in 1980, you had roughly four people working for every retired person. By 2050-ish, it's going to be two. And even if you add in teenagers, it's still very low. You go from almost six people back in 1980 to closer to three people working for every retired person. So that's a huge negative for the tax base. Next slide, please. So why is outsized debt bad? Well, a lot of people say, well, the US has the power to tax and spend, and that's great, but it does come at a cost, because when you have excessive debt, it means that when you have the next crisis, there's limited capacity to implement fiscal stimulus to help cushion the blow from a downturn. And also, there's a question of, if you're issuing all this debt, who's buying it? And we know, and a couple of slides later, you'll see that foreign investors are diversifying their portfolios away from US Treasuries. And then there's the higher default risk. And that's why, that's another reason why um, there was a downgrade today or the other day for US sovereign debt by Fitch. Um, and certainly when you lower the rating, that means the cost of borrowing is higher. So the US will have to pay more in order to get the same amount of money for borrowing. And then there's also crowding out of private investment. If you're an investor and you have the choice between putting your money in a safe government asset versus, say, a corporate bond, you're going to put your money into the treasury. And so there's less spending on private investment. And the reason why that's not that good is because a lot of the debt that's being issued is to pay for past expenses and interest, not necessarily to pay for um, things that can help generate GDP growth, like infrastructure spending, right? And then it also generates inflation. So this is a laundry list of reasons why outsized sovereign debt is not a good idea. Next slide, please. So some pictures. So who owns U.S. sovereign debt? Um, well, much of it is owned by the Fed, you can see, but also foreign and international holders. But they have been reducing their share. And the good news is that other private holders are picking up the slack, but nonetheless, it means that there's less appetite abroad for U.S. debt. And certainly, if the debt isn't rated as highly, then that appetite will continue to shrink. Next slide. Um, this is a little tough to see. I apologize, but oh, great, thanks. I should have just had one slide, but either way, you can see that the biggest owners of U.S. debt are Japan and Greater China, and those shares have been shrinking. Um, Other economies are picking up the pace and taking up some of that slack, but the point is, on the next slide, we can see that in general, there's a diversification happening. And certainly when we look at holdings of the US dollar, um, back in even 2016, roughly central banks held roughly 65%. Well, 65% of US dollars were being held by entities, and now that's shrunken to 60. So that's pretty dramatic in only a few years. So there's this diversification away from US Treasuries and also the dollar. We call that de-dollarization. Next slide, please. So can we fix this? Yes, but it's going to take a long time, because if you did it all in 10 years, so for example, here we've got getting down to pushing the debt as a share of GDP down to 70% in 10 years. So that's that red dotted line on the left-hand side, getting it to 70% in 10 years. Well, that's great. That means that the budget deficit every year would have to be um, reduced really dramatically. You'd have to have surpluses almost right away, and that's the red line, the red dotted line. And so, what does that look like in terms of revenues and outlays? If we go to the next slide, you can see that you'd have to really increase taxes a lot and you'd have to cut spending really dramatically. And that sort of action would cause significant downturn in the US economy, recession almost immediately within a couple of years. So we can't solve this problem in just a decade. It's going to take multiple decades. So if we go to the next slide, I think we have an illustration of the pain. So on one axis, you have what the tax rate would have to, how much you'd have to increase taxes, and on the other is how much you would have to reduce outlays. So if you were going to do this in 10 years, you need bigger increases in taxes and larger cuts to outlays. If you do it over 30 years, you can have smaller increases in taxes and smaller reductions in outlays. It just smooths it out. It's less painful. But most of the time when you look at any policy, it's always what can we get done in a decade without actually realizing or understanding that it would be very, very painful. And the US populace would probably not approve of it. Next slide, please. So there are tough choices that we need to make. So we need to have a national conversation about a fiscal crisis. And we need to understand this is not a quick fix. It's going to take decades. And we need to start now. So what can be done? So let's take a look at the next slide. So this is just the visual of things that we can do, right? We can deploy fiscal policy restraint. We can reform Medicare, Medicaid, and Social Security. We can make sure that we're raising enough revenues without it being too oppressive, especially for people at the lower end of the income spectrum, and also the quote unquote middle class. And if we go to the next slide, I think we have specific policies. So, for example, for healthcare, you can definitely simplify the way it's delivered. You can make sure that you are engaging in something called tort reform, where doctors are not sued for any and every reason. You can focus more on wellness over emergency care because emergency care costs a lot more than making sure that people are healthy in general. And then you can also manage end of life care costs, right? So there are a number of things that you can do regarding lowering the cost of healthcare. Next, Social Security, really basic things, raise the retirement age, not for grandma, not for the baby boomers, but for Gen X and younger. So I'm Gen X. So if, Gen X, millennials, alphas, everybody works a little bit longer and saves more, and we're given incentives to save, then we can spend less on Social Security over time. Also, we can have tax reform where you broaden the base. So more people are paying. And that means if more people are paying, not everyone has to pay as much. And you can also reduce preferential tax breaks. I think there might be one last slide. Yeah, and these are just various things, political things that can happen in Washington to make sure that every year we have a budget and that we are focused on fiscal discipline. And I think that's it for me, or at least it should be. All right, thank you.
Well, as usual, Dana, thank you. That was a great tour through the major issues surrounding the debt, and look forward to engaging you in Q&A. It's a very lively chat tonight. So our next guest tonight is Menzie Chin, Professor of Public Affairs and Economics at the La Follette School of Public Affairs. His research examines the empirical and policy aspects of macroeconomic interactions between countries. He's co-author of the book Lost Decades: The Making of America's Debt Crisis and the Long Recovery, that was published by Norton in 2011. In 2015, he received the Leon D. Epstein Distinguished Faculty Research Award, and he's been a visiting scholar at the IMF, the Congressional Budget Office, the Federal Reserve Board, the European Central Bank, and Banque de France. In 2000 and 2001, he was a senior staff economist for international finance at the Council of Economic Advisors for the White House. Professor Chin, thanks for joining us. I will note that U.S. debt has grown by about $12 trillion since you wrote about the debt crisis in your book. And it has more than quadrupled since Seymour Durst installed his famous debt clock near Times Square in 1989. And to that, I say perhaps Supertramp was onto something in 1975 when they released their album, Crisis, What Crisis? I'm sure you know that album. But we are looking forward to hearing from you why deficits, debt, and debt ratings matter for the nation and consumers.
Well, thank you, Mike, for that introduction, and thanks so much for having me on board to discuss these important issues. I had missed that exact number about how much debt had increased since we wrote the book. Must admit, I missed the Supertramp song. I'll have to go back and look it up.
Well, it's a whole album. Yeah,
terrific. I have to look up the whole album. It's a learning experience. So the first slide, thanks for having me here. I think you're going to have a little bit of repetition, but I'm going to try to just reinforce a couple of points that Dana brought up in her presentation. Excellent review of the issues. Next slide. Let me show you what happened. What happened is the debt was downgraded by a credit rating agency. What that means is the credit rating agency has decided that the reliability by which the U.S. would pay interest and repay debt had decreased. And so it took its rating from the top tier of AAA to AA plus. Okay, that's what happened. Next slide. That was in July 2011. As Dana mentioned, this was S&P and its drop in the rating for the United States. Now, what happened in the wake of that drop? Well, in a word, it's not like a lot of things changed as a consequence of that drop in the rating. You might say in a way that the rating reflected other things that were going on in the U.S. economy. In particular, 2011 was what? It was the standoff between President Obama and Congress over spending and the debt ceiling. And what we did get in the end was some negotiated deal, which entailed sequestration, an automatic pilot process to cut spending. Now, I mean, that was 2011, and it stayed at AA plus since then. And go to the next slide. You'll see this is the Fitch downgrade that occurred just a few days ago. So that dropped. What do we think is going to happen from that? In my view, it's really a manifestation. It's a reflection of things that are going on in terms of the assessment of what's going on with U.S. debt and its ability to repay the debt. Not so much it's going to cause something in and of itself. In this sense, it's not quite the same to compare credit rating agencies' determination on sovereign debt from a country like the U.S. as opposed to what they say for a company. Okay, it's a slightly different thing, and I'll try to explain why that's the case. So next slide, please. The S&P downgrade took place over a decade ago. There was no clear impact then, and it's not likely there's going to be noticeable impact now. So why do we care about ratings? For a private corporation, historical records, did this corporation pay the coupons on its the debt, on its bonds and bills on time? Okay, so you can look at the record, you can look at the financials for the corporation, you can see what the revenues are, you can see what the expenditures are. For nation states, in contrast, credit ratings measure both the ability to pay, what is it that you're getting in terms of revenues, tax revenues mostly, what is it you're spending in terms of outlays, but it's also the willingness to pay, and that's why I've italicized that. And so the willingness to pay is what is, in some sense, at issue in the Fitch determination. So next slide, please. This is from Fitch's explanation for its downgrade. It reflects, just to paraphrase, the expected fiscal deterioration of the next few years, a high and growing general government debt burden, and the erosion of governance. So I've highlighted that myself relative to AA and AAA rated peers over the last decades. And so what it's doing is Fitch is saying it's a political assessment of how much the U.S. is able to make good on the payments on its debt. Now, part of this is a self-inflicted problem because we have a debt ceiling, and not many other countries in the world, to my knowledge, no other major developed economy has a debt ceiling. Because if you think about it, it's redundant. If you are putting into place legislation on spending, putting into place legislation on taxation, then pretty much you have determined the path of debt over time. And so putting on a debt ceiling is redundant. It's going to be violated eventually. And historically, at least in the US, when you hit the debt ceiling, it just gets raised. And so not many other countries have this means by which you can inflict a whole bunch of uncertainty into policymaking. Okay, next slide, please. So when people make the comparison, you'll hear some comparison of the US to some other country, let's say Argentina, 2001. You got to think long and hard before you make the analogy. This is not to dismiss whatever problems may be facing the US economy in terms of accumulating debt, but it's to highlight, when is it that we're going to be in trouble? So, for instance, Argentina, in one of its many debt crises, it has had many, but in the one in 2001, it had a lot of debt denominated in foreign currency. That is, Argentina had borrowed from other countries in what? In dollars and in euros, eventually. It didn't borrow in Argentine reals, and pesos. It didn't borrow in its own currency. It had growth slower than the interest rate. So real GDP was growing slower than the real interest rate. And so that is a recipe for, essentially accumulating debt. And it faced both a technical constraint as well as a political constraint or inability. The technical constraint was they just did not have the wherewithal to implement a thoroughly efficient taxation system that could get enough revenue. At the same time, it could not rein in spending by the central government and by the provincial governments. And so, that's Argentina. So it runs into a hard a brick wall, essentially, and it has to default. What about the U.S.? For now, the U.S. is growing faster than the real interest rate. That doesn't mean that debt doesn't increase. It does increase because we're running a deficit each year. But the more your economy is growing faster than the real interest rate, the less quickly debt is exploding. Okay, for now, GDP is growing faster than the real interest rate. In addition, the United States runs its own monetary policy, which is in contrast to Argentina, which had outsourced its monetary policy by way of what's called a currency board. Argentina could not print up any more money than it had dollars in the central bank. And then finally, the big distinction between the US and many other countries, including many other industrialized countries, is it borrows in its own currency. We borrow in dollars. And so you can't have exactly the same sort of debt crisis that Argentina does, where Argentina had a hard time getting enough foreign currency to pay off its foreign debt. The US, essentially can print up its own money. Its debt is issued in dollars. And so that gives us a lot of freedom. In addition, as mentioned by Dana, people or international investors still want a lot of dollar assets, still want a lot of US Treasury bonds and bills. And so that gives the US a wider amount of latitude than many other countries. In fact, more than any other country in the world, because the dollar remains the key international currency. So you might want to make analogies with Argentina or your favorite, third world debtor country that encounters crises, but you have to be careful when you make those analogies. Next slide. So what is the real problem? I don't want to be Pollyanna and dismiss the challenges that we face. Dana made those quite clear. The US is running large budget deficits. We've got these entitlement costs that are increasing over time, and they're going to deplete the trust funds that have been built up over time. The entitlements that we have to spend upon, they're mandated, are going to squeeze out discretionary spending. And discretionary is what? It's not just civil servants, it's defense as well. It's everything else besides what is mandated. And so those are problems. So we do have in the US a well-developed taxation system, and it can be even more efficient if you fund the IRS correctly and or adequately, and you give them better computer systems and so forth. So we can raise the revenues that are necessary to match spending, but the problem is that to this date we haven't raised revenues to the amount that are necessary. In fact, we've been cutting taxes, as in the Tax Cuts and Jobs Act of 2017. Now, I know that at some point, if you look at these pictures I'm going to show you, you'll get this feeling that, it's such a big problem, we can't solve it. We should just throw up our hands. Social Security won't exist when we get there. But, that path is the path to not doing anything. And it should be pointed out, even if we don't do anything, Social Security runs out of funds maybe in 10 years, 15 years. But at that juncture, it's not like we don't get any benefits as a Social Security. They'll just drop to about 75% of what you would have gotten otherwise. So, don't despair. That's my major point about these issues. And in point of fact, as policy analysts, so my primary appointments in the La Follette School of Public Affairs, you can see that if you just do some tweaks to Social Security, you're most of the way, let's say 85% of the way, to solving the sustainability issue for Social Security, which is the single biggest entitlement issue that we face for the US government. So the real problem is we do not have the political will to raise revenues and rein in spending in a way that stabilizes debt to GDP. It's not a technical inability, it's a political inability. Next slide, please. Okay, so let me show you the scary pictures. This is a shorter time span for the picture that Dana showed you. Here's the CBO projection for, the black line is the debt to GDP ratio. It's debt as a share of, it's the debt that's held by the public. So it's netting out intergovernmental debt. This is, I think, the proper number to be looking at. And we're somewhere around 100%, and it's chugging along to 120. By 2050, you'll be at something like 180%. So it's definitely going up. Next slide. This is a picture of the deficits. So the black line is the, whenever you're below the zero, then that's a negative budget surplus. So you're in deficit. And you can see there was a big deficit in 2020. It's recovered a long ways, but then you can see in that brown line, the CBO projection, it's going to keep on getting more and more negative as a share of GDP. So that's the deficits as far as the eye can see. Now, part of that is because of interest payments. And so the green line is what's called the primary budget surplus. And so that thing is a little bit higher if I don't include the interest payments. Yet you'll see that the primary budget surplus is going to shrink as I go into the out years as well. So under current law, so let's say I'm not thinking about disasters. Natural disasters might occur that will force greater spending. There are no wars that are built into here. This is under current law. We're built in for deficits going into the future, given we haven't raised taxes and we haven't taken actions to rein in spending. Next slide, please. So I think actually, debt to GDP, deficits to GDP are the common ways to express the burden. I think a better way is to show how much do we have to pay in terms of interest payments as a share of GDP is a better way of thinking about the burden being placed upon us. And here what you can see is in the blue line, in 1990 or so, we paid about 3% of GDP in interest payments by the federal government. And then we got lucky because we stabilized debt to GDP. So the debt to GDP ratio shrank until Clinton, okay, until George W. Bush came into play. And on top of that, interest rates were falling. And so we had a good run of 20 years or so where, the interest payments to income essentially shrank. And then essentially starting with 2015, 2017, you saw this ratio increasing and then jumping with the pandemic expenditures. And now it's going to continue to rise in the projection. That's the light blue line. And that is despite the fact that in the red line, you can see the pink flat portion is the projection that the CBO uses for what it thinks the 10-year interest rate is going to be. In other words, we're in a big world of trouble in a different picture here, and I think it's a more appropriate one, because the amount that we're devoting to interest payments by the federal government is rising despite the fact that the interest rate is assumed to be constant. Assume that the interest rate goes higher and we're in more trouble. If the interest rates continue to fall or start falling, then we may be in a better position. But you can see this is kind of a middling scenario where we see a rising amount of interest payments. So, you go to the next slide. We are in this situation essentially because interest rates are high relative to where they have been in the previous 20 years, and expenditures keep on rising. So these are pictures about the paths of actual and expected revenues and outlays and required or mandatory outlays. This is from CBO. I will just say that it's a problem in the out years, and that's why in the short term, there's no problem, okay? So we have definitely a medium-term problem with debt expanding. We're fortunate because the United States is a special country. We issue our own debt in our own currency. We run our own monetary policy, and everybody loves the dollar for now. Okay, even if they might be diversifying a little bit out of it, they still love it. So in the short term, there's no problem. It's a medium-term problem. And once you realize that, you understand why we have this, what seems like a paradox that we've been downgraded, yet things are looking better. And so let me turn to now the short-term outlook and end there. So just next slide, please. So this is a picture of the probability of recession as seen by economists, for better or for worse. That's the blue line. And so you can see in 2020, pretty much every economist in the Wall Street Journal survey thought we were either in a recession or going to see a recession within the next year. Then it drops off as we go into quick recovery. And then the last observation we have is July. And you can see the July observation is like 50% probability. And so if we could do a August survey, I would guess that it's even lower than 50% now. The brown line is if I use a mathematical model looking at the spread between a 10-year and 3-month interest rate, what does that predict for recession in the next 12 months? And that too is declining from high levels. Okay, so indications from the financial markets, what the economists think, yes, we've got a lower probability of recession being forecasted out for us at the moment. So things do seem to be improving. Let me show you another slide, next slide. This is a picture of what the Wall Street Journal economists thought GDP was going to be doing. Blue is from October of 2022. And I don't know if you remember then, people were pretty glum. They were all pretty much saying we're going to have a slowdown, maybe a recession in the next year. Brown line is January of this year. And it turned out GDP grew faster than people expected, but still they thought growth was going to be slow. Finally, the red line is the July forecast or the survey of the July forecast. So roughly at the beginning of July, the Wall Street Journal economists pretty much said, well, we're not going to have 2 quarters of consecutive negative growth. And so things are looking better. As of today, the bean counters at the Atlanta Fed, who sort of like look at all the numbers that come in and they make a guess about what GDP will be in the third quarter, right now in the third quarter, is that blue square there. And so when people say the outlook has improved over time and people are sort of, economists are saying less and less chance of a slowdown, this is a graphical depiction of exactly that case. Okay, why this view? Well, we keep on seeing these good numbers on GDP growth. We keep on seeing employment growth, steamroll along. And so over time, people have said, well, okay, we can't see these indications of a slowdown. The last reason why I think the outlook has improved is in the next slide. And that is, you can see inflation in the blue line has come down a lot. And the Fed funds rate, which is the red line, is a measure of the Fed's monetary policy. The red dots or squares, or I guess they're kind of reddish squares, is the market's expectation. And essentially what the market's saying is, we think the Fed's is pretty close to finishing off on tightening. And so, if the Fed stops tightening, then, we may have a chance for, with continued inertia in the economy, growth to not slow down enough that we go into recession. So the rapid drawdown in inflation is pushing the expectation of a reduction in interest rates. So we don't have a hard landing, we have a soft landing. The one fly in the ointment, I'll point out, is that blue triangle there. That is the survey of consumers and what they think inflation will be in July of 2024. And they're saying it's going to be roughly the inflation rate we see in July of 2023. So inflation's come down a lot, but people still seem to think that there's going to be inflation for a while. And if that holds true, then the Fed might have to keep interest rates higher and longer. And so that is the fear that people have for why you might have a harder landing. So last slide. So I just want to keep things in perspective to wrap these, everything together. The U.S. short-term outlook is improving, and it's better for sure than the outlook that's facing the Euro area, the United Kingdom, by far, and Japan. And so things in the short term look okay, but we can certainly be knocked off by unexpected events. I mean, who would have guessed in January 2022 there was going to be a major war on the European continent? Okay, energy prices could jump up. We could have a geopolitical disruption that's even bigger than what we have now, or the China slowdown can be bigger than we currently anticipate. And I think that last point has been sort of emphasized today by the slowdown that we see in terms of Chinese exports, a big drop, much bigger than we expected. And so I think China is a big question mark. And, if China slows down a lot, the world economy slows down a lot. So lots of wild cards in there. That being said, let's say, we have these off chance events being held off. Medium term, we still have largely unchanged the challenges we have fiscally. And so for the short term, we're okay, but that long-term problem of the debt remains there. But it is a political problem, not so much a technical problem. So I've gone on too long. Thanks.
Thank you, Menzie. Great to hear both of your outlooks tonight and perspectives on the debt. Let me jump right into some questions on the debt. So Brace Clement raised an interesting question, I thought, and I don't know that we really gave an answer to this in our presentations, but do you have a view on what the optimal debt to GDP ratio is? I know, in the US, it sort of peaked at 100% in World War II, at the end of World War II. And, we probably could rationalize why debt to GDP was a lot higher at that point after fighting a war. And now, of course, we're back up around that same 100% debt to GDP, give or take, right? And projections are that we're going to go, the next 30 years to 180%. What's the right level that we should target? I know in some of the charts we talked about what we need to do to get back to 70%, but is there a kind of a magic ratio in either of your minds? And I'll start with Dana and then go to Menzie.
Well, the IMF says that for advanced economy, 70% is optimal. So that gives you some fiscal space if things go wrong. And it's not the case that your debt is growing faster than your economy. So that's some of the rationale.
And the IMF, we all know, I mean, well, I don't know. I mean, they say that for everybody. Maybe for the US, we're in a different situation.
For advanced economies. For emerging markets, it's actually lower. It's more like 35% of GDP.
And if you're the reserve currency, does that give us any more leeway?
I think it does. For the reasons that Professor Chin mentioned, that we can technically, quote unquote, print money, and we could monetize the deficit. I mean, that's modern monetary theory, and a lot of people say it's kind of junk theory. But it also means that your central bank is no longer independent. But these are possibilities, right? But we've seen that movie. It's a bad movie in other economies where central banks are no longer independent and the debt gets monetized.
Professor Chen, thoughts on that?
Well, I haven't thought about what is the actual optimal number, and I would say I agree with Dana that as a reserve currency issuer and as the reserve currency issuer, we enjoy what Valerie Stang called the exorbitant privilege of being able to issue something that lots of people want. So the fiscal space that we have in the United States is probably a lot bigger than for other countries, even other advanced countries. What the optimal level is, I don't know if I'd be willing to put a number on it. And it's not clear to me that it's a debt to GDP number. Once again, it may be a net interest payment to GDP number, because that's kind of like, if we analogize it to ourselves, that's like how much we have to pay in interest as a share of our income. And what's true is we have a lot more debt than we did, in let's say 1990, but the interest rates worldwide have been coming down for 30 years. And so I would say a better metric is if you see your interest payments as a share of GDP going up fast, that's the thing to worry about, rather than necessarily level of debt to GDP. That leads to the question is, where will interest rates land? And for the past 30, 40 years, we've been thinking about how strange it is that long-term interest rates have been falling and projections have been always consistently too high for the last 30 to 40 years. But maybe we've turned a corner and now is the time where we'll be too low, and then we'll be in a world of trouble.
So since we've been talking a little bit about that special privilege of being the reserve currency and how that might give us a little more headroom, Steve Goldstein asked earlier tonight, what if other countries in unison start selling off all their US debt? I mean, first of all, I want to ask you, Menzie, is that likely to happen, and would that be in their interest to have some big coordinated sell-off? And then secondly, is it plausible? I mean, where would countries go for a reserve currency if not the US?
Yeah, I think this is a salient question. It's an excellent one because people have been thinking a lot about this. Particularly, it's not been driven so much by excessive debt buildup in the US because debt's been building up in many other countries, but it's the fear of US sanctions. And so can I diversify my holdings into either non-dollar assets, or almost importantly, diversify my holdings to places which are out of the reach of US regulatory authorities. And so, I can see a number of countries have tried to move that way. They've tried to move out of US dollar holdings to some success. They've tried to set up alternative payment systems so that they can undertake transactions outside of SWIFT and so forth. But those things have not, in general, been big enough to move the needle in terms of how willing people are to hold dollar assets. So for now, I think if there's a driver, it's not because treasuries are becoming less desirable versus other assets, because all the other assets are, in some sense, becoming less desirable as well. So we're the least dirty shirt in the suitcase, in a way. So I'm optimistic in that sense. But if we were to accelerate how fast we increase debt because we are unable to come to some political resolution, then Fitch's warning is probably right. It's just we don't know the timing about when it becomes relevant.
Dana, any further thoughts on that?
I mean, I agree with everything. And also just thinking about trade, most trade and transactions are done in US dollars. So it's kind of difficult to get away from the US. And there are other reasons for why the US is attractive in terms of holding our currency in our treasuries, is because we have rule of law, we have governance, we have regulations, and many other economies don't have that infrastructure to support an alternative measure, an alternative currency in that fashion. I mean, do you have erosion? You do have some erosion. Certainly, China's and Russia and are working to come up with alternatives. The China version of SWIFT, which is what Russia's using right now to avoid U.S. sanctions, and then China set up oil payments with Saudi Arabia and yuan, but it's really on the fringes, and you need some other currency and banking system that is as strong and I guess powerful as the U.S. to fully replace it.
Yeah, pretty broad and deep capital markets here with a long history of honoring obligations. And that is not going to be easily replicated by China, certainly.
Yes.
Getting back to kind of debt and deficits, it does seem like the problem in the country really is the parties don't agree on the issue of the optimal size of government. I mean, that is fundamentally, in my opinion, what's happening here. And, Chuck Weiss asked earlier tonight, is this a revenue problem? Taxes are too low, or is it a spending problem? And do you have thoughts about that? I mean, should we be moving to an economy with significantly higher taxes to fix the problem, or is there too much government spending?
It's both.
Meet in the middle.
So the thing is that you do need more revenues. It's how you collect the revenues and from whom you collecting them from. So there's always talk about getting rid of loopholes, but no one ever does it, right? But that would help generate revenue. You also need to expand the base, the number of people and entities that are actually paying taxes, instead of concentrating it basically in the middle class, right? And in terms of spending, yes, there is outsized spending, and some of it is a big chunk of it is mandatory. We've made promises to the older generations that we would take care of them, and now the bill is coming due. So the thing is as Professor Chin mentioned, and I also mentioned, there's some pretty easy fixes to Social Security to ensure that there is something in the pipeline later for when my generation and generations after retire, and to make sure that we meet those obligations and the promise that we've given of a social safety net for our elders. But it's about political will. Whenever we talk about Social Security, everyone has in mind my 100-year-old grandmother or my 70-year-old parents. They're not really thinking about the younger generations. They're just imagining putting grandma and mom and pop out in the street. And it becomes a political discussion almost immediately.
Good observation. Menzie, did you have something?
Kind of a big problem from my perspective. So I'll just say, if I had my druthers, I would say you could probably raise revenues by just taking tax rates up a ways, broadening the base. We don't have a VAT, which would be a lot more efficient way of collecting revenue, because we know income taxes are kind of a distortionary way of raising revenue. But I'm not sure how much we can squeeze out of spending, because what's the characterization of the U.S. government? It's an army with an insurance company, right? That is most of what the U.S. does. It's defense, and it's Social Security, Medicaid, Medicare, and so the question is, in some ways, how much should you be spending on these other things? Even if you squeeze them out, is there much to be reduced in terms of share of the economy?
Yeah, or could they be done more efficiently, perhaps?
Yes. Yes.
I'm kind of pulling together a theme of a few different questions that came in. And I think it does go to broader issues about, just kind of our industry's credibility. I don't mean just economics and economic forecasting. It could be, climate change or whatever. A lot of these long-term issues that we worry about, I do think people rightly question, well, what is the track record of economic forecasters about things? And, I was joking, of course, about the Supertramp album, but the reality is the United States economy has had very strong relative performance for an advanced country. That is, for us to grow or boost productivity, we have to invent new stuff because we're already on the frontier. Other people are like borrowing our innovations. Sometimes it's hard for me to make the case that this debt burden is really causing a problem for us. Yet I think we all understand that, by the time debt becomes a problem for you, by the time you realize it, it's too late. And so how do we get people to come around to that? When you think about either country debt crises or Lehman Brothers, you name it, things are fine until the day everybody decides they're not. And then all hell breaks loose. And, how do we create urgency around this issue? Because I tend to agree with you, but I also have a hard time selling it, and I kind of understand why.
Well, I think we can look to Canada. So Canada back in the 90s had an outsized debt problem, and they essentially had a national conversation. They said to the populace, look, we have a lot of debt at the government level, federal government level, central, whatever they call it. And it's not good, and it's going to weigh on the economy, which is bad for you. So that means we have to go through a period of austerity to get to a place where we can actually grow. And somehow policymakers were able to communicate that to the populace, and they went through a period of austerity, and then they went through a long period of growth. But it also coincided with the commodity super cycle. So it's a little difficult to disentangle the two. But the thing is that you have to get the populace to buy into it. Same thing with the sovereign debt and banking crisis of 2010 through 2012 in Europe, where you had the crisis, and then the understanding was, if we're going to get back to growth, there's going to have to be a period of pain, and different economies in Europe handled that differently. In Germany, it was like, absolutely, we get it. Other economies, it was a much more difficult conversation, right? But you have to convince people that this is something that's going to be bad for them, or at least bad for their children. Maybe that'll move them.
I think that's as good an answer as any. I would say the only thing that I can think of as economists is we can point out to you can point to an example. So don't be a Great Britain. Don't be, I don't know, don't be in Argentina. If you can find an example that's close enough, then you might be able to say, point to these things and say, well, now you really have to get your fiscal house in order. Or you have to make tough choices of some other nature. If you want to save Social Security, raise the retirement age, allow in more immigration, hope for a productivity boom, but you can't let it just keep on running on, because eventually something's going to give.
Yeah, it's a great observation. The country hasn't had kind of a unifying national project, which, sadly can sometimes be something like a war, but there hasn't been enough of, I think, a crisis or an urgency that has brought the country together to really rally. And, So there's probably a lot of different views about how we need to tackle this, and not a great track record of compromise in government right now. And again, that's probably a manifestation of not having had a true national project in a long time. It's allowed people to drift pretty far apart and put their personal interests ahead of what a national interest might be. And I don't know what would make that happen, but surely seems like something we need. We are at the top of the hour, and I just really appreciate you taking the time tonight. A lot of great comments in the chat this evening, a very vibrant group. Sean Grady, I want to assure you, I am not in a well-appointed fallout shelter. I do have a ladder from my main floor to my second floor, but I'm not in the basement right now. I'm living well. All is good here in Badgerland, and thank you, Dana, and thank you, Menzie. It's great to have you on the show.
Thank you, Mike. It's been a pleasure.
All right.
Thank you.
Take care. Well, thank you all for joining us this evening. To our audience, the live stream will be back on September 12th. If not before, maybe we'll get a more exciting issue and have a show on the fly sooner than that. As many of you know, this year marks UW-Madison's 175th anniversary. And as part of our community, you can visit the 175.wisc.edu webpage to learn more about upcoming events and celebrate the many ways that UW has enriched our society. In the meantime, I hope you'll enjoy this video showcasing UW-Madison's proud legacy and brilliant future. Thanks for joining us tonight, and on Wisconsin.
In 1848, just 2 months after the creation of our beloved state, a great university was born, the University of Wisconsin, to serve, educate, and benefit people from every corner of Wisconsin and beyond. And for 175 years, we have pushed forward, energizing dreams and igniting innovation. With educational opportunities that create promise and research that improves lives, UW-Madison is a place where an idea can change the world. And as we look forward, we also look back to stand up for what's right, build common bonds, and a better future. When combined with inspired goofiness and Badger spirit, there's an inspirational and unconventional vibe that's all Madison. It's more than just fun and games, though. At the UW, we go from brainstorms to breakthroughs, from today's students to tomorrow's leaders. This is where an idea can change the world, the whole world, a corner of the world, my world, our world. UW-Madison's profound eurekas and personal ahas transform us all and serve the greater good. As proud Badgers, we celebrate the last 175 years and the next as the UW charges forward. On Wisconsin.